The typical individual in their mid-20s in the US has around $10,000 in retirement savings. How much cash dividends could you expect from a portfolio of that size? While $10,000 will not be enough to finance a traditional retirement, you might be shocked at how much it will pay in dividends on its own. Maybe it would be enough to cover your costs or pay for a vacation. Examine the various situations that would result in various levels of income. This will give you an idea of how much money you'll need to become independent financially. Hello there! Thank you for visiting Usable Wisdom, where we will show you the most recent financial, business, and entrepreneurship tips and tricks. In this video, I'll discuss the process of earning dividend income from $10,000. If you haven't already, subscribe and click the notification bell to be notified whenever we upload new videos. And now, if you want to learn about a major error that some investors make and how you can optimize your investments to make substantially more money in the future, then keep watching. Many investment options offer different degrees of dividend income. The S&P 500 index is probably the most popular investment. This is so popular because it gives investors access to 500 large US corporations with a track record of stability and profitability. It's also well balanced, which means you own a piece of each sector and industry that comprise the stock market as a whole. Warren Buffett recommends the S&P 500 because it has a strong track record of producing healthy returns. This is what most investors mean when they say the market. If you buy an ETF or index fund that tracks the S&P 500, you'll get a dividend yield of less than 1.5%. This is because many of the biggest shareholding are technology companies that are recognized for paying little to no dividends. The index would only provide about $150 per year, or $12.50 per month in dividends with a $10,000 investment. The Dow Jones Industrial Average, also known as the Dow, is another popular investment. This is another index that is commonly referred to as the market by investors. The Dow, which is typically ranked second to the S&P 500, is comprised of 30 of the largest US corporations and is regarded as a secondary indicator of the health of the US economy. Investors who purchase the Dow fund will receive a dividend that is slightly higher than the S&P 500, at just over 1.5%. An increased dividend yield could be obtained by investing in a fund that focuses on income rather than capital appreciation. There are numerous high-quality options that invest in stocks of stable companies with a long history of dividend payments. The Invesco S&P 500 high-dividend, low-volatility ETF is one example. This results in a dividend yield of around 4%, which is considerably larger than the average S&P 500. Rather than owning all of the companies in the S&P 500, which only owns those that pay the highest dividends. As a result, growth has slowed significantly in the long run. With a $10,000 investment in this fund, the annual dividend income would be approximately $400, or $33 per month. There are numerous other high dividend funds available for older investors. They are popular among the elderly because they provide more stability. They outperform during bear markets and underperform during bull markets. When you combine that consistency with the regular income, it's no surprise that these are common among retired people. Another way for people to earn higher than average dividends is to invest in a sector or industry-specific fund. A fund like this only invests in a single sector or industry, such as power generation, property investment, or healthcare. Because of the nature of their business, some sectors pay higher dividends than others. Because many investors are scared of the fluctuation caused by economic volatility, renewable replacements, and regulations, the energy sector is valued relatively low and has a high dividend yield. For instance, the Vanguard Energy ETF has a dividend yield of no more than 3%. Real estate investment trusts are also considered relatively risky, and due to their business structure, the majority of their profits are distributed to shareholders in the form of dividends. The Vanguard Real Estate ETF also has a yield above 3%. Investors who are willing to conduct research and purchase sectors that have fallen out of favor have the potential to earn high returns. As the sectors rotate back into favor, the returns will be in the form of dividends and capital appreciation. A $10,000 investment in Vanguard's real estate or energy ETF would yield approximately $300 per year, or $25 per month in income. Moreover, buying individual stocks is just another option. Although many financial experts advise purchasing index funds or ETFs if you are an amateur investor with a small portfolio, you can come to know about market behavior, earn consistent returns, and expand your portfolio without risking too much. If you are eager to do the research and take the risk, you may eventually select individual stocks. If you do intend to buy individual stocks, you should look for historical records and dividend growth. For example, the Dividend Aristocrat list is a good place to start because each aristocrat has a history of raising their dividend for 25 years in a row. Aristocrat dividend stock, such as AbbVie, pay roughly a 4.5% dividend. If you invested $10,000 in this company, you would receive approximately $450 in dividends per year, or $37 per month. You will also obtain any capital appreciation or depreciation based on the stock's future price. Besides that, it's a good idea to look at those prospects' fundamentals. Check for plausible payout ratios of 50 to 60% or less positive earnings, as well as a variety of other prospective metrics. Individual stocks offer opportunities for bargains because they frequently sell off, whether as a result of recent bad news, an earnings miss, or management changes. Because the stock market tends to overreact, this could present an opportunity. A wise investor must assess the gravity of the news and act independently about the stock price, because most investors with $10,000 or less are a long way from retirement. They should start considering disregarding dividends entirely. Why? Because investing in growth stocks can make you much more money in the long run. Because dividend-paying investments have historically had generally lower rates of return, those who are still young must normally see growth. Over the course of a career, a 2% difference in the annual rate of return can make a significant difference. For example, somebody who invests $10,000 at the age of 25 and earns an 8% return until the age of 65 will have $217,500. If they had earned a 10% return, they would have $450,000, or more than double the money, by the age of 65. It's worth remembering that growth stocks can be more volatile, which can be challenging to handle for investors who are unfamiliar with market fluctuations. An ETF, such as Vanguard's Growth ETF, VUG, is a great option for younger investors. As the title implies, it invests in large-cap growth stocks, such as Apple, Amazon, Home Depot, and other well-known names. Over the long run, a growth index is likely to outperform the S&P 500, which is excellent for somebody who has many years until income is required. VUG's dividend yield is less than 0.5% because the majority of the holdings pay little to no dividend. Instead, they reinvest profits back into the company to ensure that it continues to grow at a rapid pace. Because of the low dividend yield, a $10,000 investment would only yield less than $50 in dividends per year, or about $4 per month. There are numerous high-quality alternatives to this fund that have historically outperformed the market. People are often engrossed with dividend yield and settle for the wrong investments for their time horizons. Overall, an investor with a $10,000 portfolio would be better to concentrate on growth and ignore dividends completely. How much of a difference does money make in your life, whether it's $50 per year or $400 per year? When it comes to paying bills and funding your daily expenses, that amount is unlikely to be significant. When you're getting close to retiring, growth stocks would then provide you with more money. If it makes any sense, you could convert your growth investments to income investments at that point. Don't make the rookie mistake of focusing solely on dividend yield. Thank you for your time. I'm hoping these tips come in handy. If you like this video, please subscribe and turn on the notification bell so you can be notified when we upload new videos like this. We'll see you next time.